Hi, thanks for joining me on my Market Report. My name is Mike, and my Market Report is on mortgage rates. We discuss on a daily basis what impacts mortgage rates, whether it might come from the economic calendar, could come from headline news, or even geopolitical, combination of those three. But sometimes it gets even more confusing if you're while you're watching that good news is now bad news as the market sentiment changes. So we're here to try to give you that information and background information as to what's going through the minds of investors and why they're doing what they're doing and why the market is moving in which directions. So a little bit about myself is I am a loan officer. I do work as a work with a national lender. We do loans in all 50 states. If we could be of any service to you with your refinance or purchase needs, please reach out. We're here to help you guys out. But more than that, we like to be a resource for you folks. So if you guys got questions about anything, again, we're here to answer any questions that you might pose. So without further ado, we'll just jump right into the economic calendar today. So the main item here, we got two main items here. We have the new home sales and we got the consumer sentiment. But there's some items here that normally we don't look at in the consumer sentiment that was pointed out by the Fed chair, and we'll touch on that here in a second here. But first, let's start off with the new home sales for the month of May. So April was actually revised higher. It went from 591,000 to 629,000 seasonally adjusted units. Now forecast was calling for 588, and it jumped up 10.7% to 696,000. So that's a pretty big jump after having a decrease in the month of from March to April. So good numbers overall there. Then we got consumer sentiment. Anything above 50 is considered expansion or good. So we had 50.2 back in May. Forecast was supposed to be remain unchanged, and it's right on that verge. We're at 50 right now. So consumer sentiment isn't too good right now. This is actually one of the lower numbers we've seen in quite some time. Now, the point I was made previously regards to comments made by the Fed chair this week is that he touched on the sentiment by the consumer of where they view inflation going to be, and in the from the year and the 5 year data. So right now, out of 1 year out, they figure it'll be was before at 5.3%, and now it's coming in June. It came in at 5.3%. Now, the 5 year outlook went from 3.3% in May to 3.1% in June. So some improvement in terms of the inflation outlook there. So that's something that was kind of easing the markets as he did speak a little bit about. Before they were worried about this endless amount of Fed hikes because there's really no seem to be any stopping point, and I think they kind of, especially when they look at the dot plot. Now, I think as he talked a little bit about this sentiment, that maybe that kind of eased their concerns a little bit, and markets started improving a little bit. So we had a change out there in terms of, as you saw here, we're all the way up like 77 basis points, but ended up closing up around 20, I think it was up 25, 23 basis points yesterday. So that was about a half a point swing in the day here. So even though markets improved, the pricing improved from the previous day, they did get some price repriced for the worse as investors were pricing much higher at the 77 basis points and came in as the market finally closed in lower. Today we're down about 17 basis points, so we kind of lost that steam and kind of gaining that momentum. A lot of that, again, the stock market is taking money from the bond market, is going into the equities, and that's what we're kind of seeing here right now. That money's kind of flowing from one to the other, and they're feeling a little bit more easy about things. So they're taking out the flight to safety back into the equities market where they get more rate of return on their money on there. So that's why they're doing what they're doing. We also had have been kind of impacted by Europe. We did start off the morning yesterday primarily because Europe came out with some pretty poor PMIs. So there's a lot of bond buying in Europe, which kind of trickled over here in the U.S. Today, again, Europe was doing a lot more selling off of mortgage-backed or their bond market, and that kind of trickled over to here. So it wasn't faring as well. So we kind of had this trickle effect coming over from you got the Asian markets and the European markets, and it comes over here. And by the time European markets hit over here, we kind of followed suit a little bit for the most part. So yields did climb a little bit from where we were yesterday. We were down to like 3.03 at one point yesterday. Now today we're just under 3.13, so a bit of a spike there compared to where we were yesterday. Um, and last but not least, let's touch on what's going on with the rates. Again, these are based off, they're about 1 day delay, and they do have points built into, so that's why you're not seeing the 1/8 increments built into these. Um, so the 15 year is now at 5.125 or 5.12, and the 30 years at 5.75. So we're under the 6% range, which is good news. Again, if you guys want any quotes on rates or anything we could be of assistance, please reach out. We're here to help you guys out. In the meantime, if you guys like these videos, please help us out. We greatly appreciate it if you can share and like these videos. It helps our channel out, and we greatly appreciate it. Thank you so much for watching. Hope you guys have a great rest of your day. Enjoy your weekend. We'll look forward to see you guys on Monday's video. Bye-bye.